Hi, I'm Paul Gillis. I'm a professor at Peking University's Guanghua School of Management in Beijing. I have lived in China for the last 16 years. I was a partner with Pricewaterhouse Coopers, then retired, went back to school, got a PhD, and became an accounting professor. I'm active in many areas related to U.S. and China investment. Cross-border investment, and particularly issues dealing with cross-border regulation. I write a blog about Chinese accounting, the China Accounting blog, and I've got a book coming out this fall on the Big Four in China, on how the Big Four came to dominate the accounting profession in China and how local firms have been trying to take it back. That'll be published by Emerald in the fall, and it's based on my doctoral dissertation. The pace of development in China really took off. Zhu Rongji looked to accounting as a tool to reform the economy. The Soviet accounting system was based primarily on meeting government targets and achieving government policy objectives. And he concluded that a market reform was necessary. You needed to focus more on making businesses efficient and making them profitable, and Western accounting standards led to that. In addition, China's companies needed to raise capital. In order to compete in the world, they had to become more efficient, and they had to become more profitable and more successful. And a Western-style accounting was viewed as a tool to help get those companies to become competitive. China's entrepreneurial sector became legitimate. Legal anyway, shortly after opening up. It became possible to start a private business again, but it didn't really become legitimate for some time. So private entrepreneurs surfaced in China, and there were many of them, but they had great difficulty accessing capital. And they still have great difficulty accessing capital. The Chinese stock exchanges, which reopened in 1990, were really only available to state-owned enterprises. Banks, Chinese banks, would not loan to anyone other than a state-owned enterprise because loans to state-owned enterprises were effectively government guaranteed, and the others were just simply too risky, so they wouldn't do it. Ideological problems also gave some bank officials the view that they shouldn't be supporting private enterprise. So private entrepreneurs had to find a way to raise capital, blocked from Chinese exchanges, blocked from other sources of capital, really had to go two ways. One into China's shadow banking system, which is causing great problems now for China. And then many others went overseas. They went outside of China to raise capital on foreign stock exchanges. When Chinese companies decided to list abroad, both state-owned enterprises and private companies, they had to have audits because all foreign stock exchanges require audited financial statements. And no one was going to accept an audited financial statement done by a Chinese CPA firm that was owned by the state. So the Big Four basically dominated that business. So they did the audits of these companies. Some of them were very challenging. One is reported to have taken 3 million hours to complete the audit of one of China's major enterprises. It was a big task, but it got these companies onto the foreign markets. We then had a new phenomenon, and that was reverse mergers. Many small Chinese companies found a backdoor way onto the U.S. markets. They would find, or actually a promoter would find, a public shell of a company that was already listed in the U.S., may have been in a completely unrelated business and may have gone belly up, filed bankruptcy, but somebody kept the public shell alive. A Chinese company then would merge into this public shell and then immediately become a U.S. listed public company. In those situations, they weren't required to have an audit before they became public. They weren't required to go through all the due diligence that takes place in an IPO. And unsurprisingly, a lot of them turned out to be frauds. The Chinese stock markets have performed very badly for a number of years. There was an interesting study McKinsey recently released that in 2011, 2012, investors in U.S. listed Chinese stocks lost 72% of their value. I mean, that's a huge loss. And 1 in 5 companies were delisted. So we've had a scandal, an accounting scandal here of unprecedented scale. Accounting firms were necessary to help Chinese companies raise capital abroad, and it helped them to put in the accounting standards, the reporting standards, and gain the credibility that would allow foreigners to invest in these companies, and helped to provide management with the kind of information that could allow them to manage these companies more effectively. When all the frauds began to appear in China, I mean, everyone questioned immediately the competency and the integrity of the accountants in China. That was a bit unfair. I think we've got to look at this as the market had grown so quickly, and China has a shortage of experienced accountants. Also, they had brought Western accounting and auditing methods to China, and they didn't always work very well in China. They had underestimated how many controls that were put in place in the West that relied upon separation of duties were easily subverted in a culture such as China, which is more collaborative in nature than Western cultures. So the accounting firms were caught somewhat flat-footed by the mistakes that were made. They're not entirely blameless, but it's also when someone commits a fraud, it's sometimes very difficult for accountants to find it. They were lied to too in this process. And so, while they're not blameless, they're also not entirely the ones that are at fault. When I came to China, we had just started hiring from local universities. The accounting firms got a license to practice in '93. That's when they could really begin to hire people from local universities. And at first, we couldn't find enough graduates. The firms still struggle to find enough highly qualified graduates. Because what they needed more than accounting skills, they needed people who could also speak English. Because the reporting, international financial reporting, is typically done in English. If a company lists overseas, it's got to report in English. If it's a multinational, it has to report in English. So English language capabilities were very important. And people with strong English language capabilities were pretty scarce in China in the early days. Now that's improved every year. And what I observe in my classrooms now is every year the quality of English gets better. And each year it becomes easier to teach in English in China because the quality of the language and understanding the English language just continues to improve every year. Originally, the accounting firms had to go find people who could speak English and not really care about what they studied. Often we'd be hiring people that were working at the hotels. You'd find if you'd go to a hotel bar and there was a waitress who spoke English pretty well, she might be an accountant the next week because that's the kind of people we needed. And they'd go to the universities, and great top universities like Beida, and recruit more heavily out of the English language, foreign language programs than out of the accounting program. Now that all changed, and it has changed, and now the majority of graduates who go to work for the big accounting firms are studying in the accounting programs and the business programs because they've got the English language capabilities as well. But language was a big obstacle to developing accountants in China. You know, what's exciting now about teaching business people and accountants in China is to see how bright these people are and how capable and dedicated they're going to be towards their careers. And I'm quite optimistic about the future in that respect, is that I think there are some really talented people coming down the pike. Now the problem that China faces is it takes a long time to get the experience to be what we used to call in the Big Four the no-hair, gray-haired partners. You know, and you need some partners who are 50 years old, who've got 30 years of experience, who have seen the issues and know how to make the tough judgments, especially on these really big companies like some of China's largest SOEs. You really need some seasoned partners, and it's going to take some more time before there's enough of those people around in China. When we started to see a lot of frauds in China, a lot of them were were uncovered when short sellers started to expose that the accounting in some of these companies was a little bit suspect. Many of these companies then would immediately collapse. They'd be delisted from the U.S. stock exchanges. Investors would be wiped out. The SEC, which is responsible for looking after investors' interests and regulating companies that list on U.S. stock exchanges sprung into action, as did the Public Company Accounting Oversight Board, which is responsible for regulating the auditors who audit U.S. listed companies. And so they tried to come to China to get to the bottom of what had happened in some of these early frauds. In China, when they tried to do that, China said, no, you can't come to China. Allowing foreign regulators to investigate Chinese people on Chinese soil for violations of foreign laws is simply a violation of China's national sovereignty, and we're not going to allow it. Plus, we're not sure these documents that you want to see might contain state secrets. You know, we don't know, but we can't just have people provide documents, business documents, particularly on state-owned enterprises, to foreign governments unless we're certain that they don't contain state secrets. And now most of these audit work papers are not going to contain any state secrets, but when you start talking about some of China's big companies, you know, like its big banks and PetroChina, yeah, there's information in there that might be sensitive, that they would prefer that U.S. regulators don't get a look at. The SEC said in the hearings last week about the accounting firms, it told the judge that, you know, while China had said that it would provide these working papers, that they didn't see that was really a workable solution. You know, the SEC really wants to be able to go directly to get the information it wants. It doesn't want China to vet this information first, to redact anything that might be a smoking gun or might lead the SEC in a direction they don't want them to go. I mean, that's just not the way the SEC operates in the U.S. So the SEC is being told they have to do this and deal with China in a way they're not accustomed to dealing with things. They're losing control over the process. And so they've got some legitimate concerns there. The PCAOB simply hasn't been able to make any progress at all. I mean, they've made modest progress in the sense of being able to get documents for investigations, but you know, they only did 3 disciplinary actions last year. They look at hundreds of audit examinations. So they're not going to. This is not an effective means for. This is not an effective agreement for the PCAOB. I think the SEC, though, at this point, it's been pretty much boxed into a corner. I mean, China has cleverly given the SEC just enough to keep it from exercising the nuclear option being kicking all these companies off the U.S. exchange. So the SEC now, if it took that position, it would be viewed as operating too extremely. And I think China has quite cleverly recognized how far it can push on this. And so China's kept itself completely in control of any information that gets to the PCAOB, yet they're going to give the PCAOB and the SEC enough information to keep them from being able to take the extreme option. So they have really out-negotiated the U.S. regulators in this situation. And I think that was not surprising. I mean, the SEC and the PCAOB are a little short on political capital right now. And in Washington, there's the heavy hand of the regulator is not welcomed. And I think they are unable to take that kind of action. Now, what this means for investors is that if you invest in a Chinese stock, you don't get the same level of investor protection that you get if you invest in a domestic stock. You can't count on the SEC completely fulfilling its responsibility to investigate and to punish fraud that might take place. You can't count on the PCAOB inspecting the auditors to make sure that they're really following auditing standards. So as a result, there's a lot more risk in investing in Chinese stocks. Of course, investors already know that.